Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is April 29th of 2024, the last update of April. And fortunately for a lot of our investors, April has remained a constructive month despite that market pullback. Nevertheless, as part of our process, we want to always assess the state of a market correction and what are some of the underlying dynamics or trends that we're seeing take place underneath the surface. Because stock market corrections are one of our number one ways of assessing what's working and what's not working in a market so we can prepare for that eventual market recovery. So let's go ahead and get started with this week's update. Now, the title of this week's update, not shockingly enough, is this bull market back on? And the answer to that is maybe, right? And that's always the case when it comes to markets, is that you can never really deal in certainties. What you can deal with are likely outcomes based on evidence, right? And in many cases that may prove to be false. But what we're going to do this week is go through the state of that stock market correction. Number two is the Chinese market beginning to emerge from its slumber. Now, we've obviously taken a very contrarian approach with China. We know a lot of the pessimistic feelings, both geopolitically and economically, that are associated with China. On the other hand, we're looking at companies that are global companies that are very cheap, and the stocks are beginning to act in a way that is not aligned with the narrative that we see in the media. That always perks our antenna. And when we see action like that, we start to chip away. Lastly, what's not working in this not bear market, but what's not working during this correction, and what's working during this correction, and is that evidence of a change in leadership or reinforcing previous leadership? And then lastly, what are credit markets saying? If we look here real quick before we get on to the next slide, I did want to show that one of the reasons why the market has reacted so negatively to inflation is that the reality is that inflation for a lot of people is higher than that headline number. So if we look at what we call a common man inflation versus wages, so that would include things like food, energy, shelter, clothing, utilities, so electricity costs, natural gas costs, heating, and then, of course, insurance. That includes car insurance, life insurance, P&C, all that type of stuff. We can see here far outpacing wages. So yes, there's been good wage growth, but for the average American, prices have gone up faster than their wage growth. And that's a big problem. And the other issue, of course, is that these people are going to demand higher wages, which then, guess what, pushes up inflation. So this is something we want to keep an eye on when we're looking at the portfolios. What is a portfolio that can act well during an inflationary time like we're in right now? And that's been a message we've been very consistent with. Now, in terms of the state of the correction, the internals do look fairly flushed. I think that's the good news. Right now, a correction can be the first step toward a bear market. So the key really is, what was the state of the bull market when we entered into it? And what we've said in previous weeks is that the bull market looked very healthy, wide breadth across sectors, good volumes. And so nothing that was conducive to what we would say a yellow flag or a red flag that would cause us to say, hey, like this bull market looks like it's on its last legs. This really does look like a bull market stock correction that you would want to buy into or hold into. When we look at the bounce so far, the rallies Monday, Tuesday, and Friday exhibited pretty decent 4-to-1 plus breadth. So that's what we would want to see on a bounce. It's a solid first attempt at an oversold response. As we said last week, markets were starting to get oversold, still have some more work to do. Really, as of now, when I'm recording this, the S&P is around 5117, which puts us right below that first point of resistance of 5120. So we're not out of the woods yet, is the answer to that. But if you're in the right areas of the market, it may not matter. And so I think that's one of the big things that we want to focus on today is the S&P 500. Yep, we might get another leg lower, but if you're in the right areas, it may not matter. Okay. So very, very key message there. We talked about the internals in terms of the percentage of stocks. You can see here in the bottom right, at a 20-day low, reached that 57% mark that we want to see. And obviously now trending lower as we get that bounce that's forming in the market over the last week or so. Now, as it relates to technical support, that 48.25 was a key level that we were looking at for support. Haven't reached it yet. So when we kind of think about yes, some of the short-term internals are flushed. We're right at overhead resistance, and it's really only been about a 5% drawdown so far in the S&P 500. Would not surprise us if we did get another test and maybe went down to 48.25. That's not our call. We're not trading or moving the portfolios based on that. But if you're putting a gun to my head and said, hey, like, could the market go lower? I'd say, yeah, it could, right? It would not surprise us at all to see 48.25. We would be buyers at those levels for sure, unless something dramatically changed that changed the narrative. But overall, I would say, we've worked off a good chunk of that overbought condition from a few weeks ago. And now we're in a spot where at the very minimum, we can look at sectors and individual stocks and say, hey, there are some areas that we can definitely do some work in and chip away and do some buying. When we talk about buying that dip, right? So when we buy a flush in 20-day lows in the stock market, historically, that has led to better forward returns versus if you were just buying the market in any other time period, right? So when we look at plus 20 days out, you get about 2.3% return when you're buying that flush in 20-day lows when they're greater than 50%. Remember, we reached 57%, 5.3% over 65 days, and then 13.4% over 250 days versus the 8.8% average. Of course, there's a catch to that, right? And we talked a little bit about this a couple minutes ago. You want to be in a healthy bull market prior to that pullback. If we were in a deteriorating bull market with narrowing breadth, we would probably want to look to any rallies to lighten our exposure in stocks. But because we entered into this correction with a head of steam, I think we want to use these pullbacks and spikes in 20-day lows as moments to add exposure. I think that's important. Credit markets remain well behaved. When we look at what happened in COVID, I wanted to include the COVID period, not because it's indicative of how you can play defense with credit markets, because COVID came out of nowhere, basically. It wasn't like 2008 where credit markets slowly creeped up while the market creeped up and you had time to play defense. But what I wanted to show is that when this line goes up, that's bad. And when this line goes down, that's good. When this line goes up, when credit spreads go up, it means the cost of credit is going up. It means implied risk at the business level for private US companies is being perceived to be rising. In other words, they're less likely to pay back their loans. So during a stock market correction, our team will sit here in the office and say, well, what are the credit markets doing? Are they confirming or rejecting the action in the stock market? And what we can see is they're kind of rejecting it. We have not seen any real pop in the credit markets. So in other words, they're saying, hey, you know what? In credit land, everything's working normally. Capital is freely flowing from banks to companies. Companies are paying on time. We don't see anything there on balance sheets that lead us to say, ooh, you know what? Like there's some risk or some danger here. And remember, this is actually happening at a time when interest rates have backed up quite dramatically. So a very, very positive signal here from credit markets as far as we're concerned. One area that is starting to crack, and we've talked about this since the start of the year, and it continues to play out, is technology. Now, yes, there was a big quarter from Microsoft and a really big quarter from Google. And the move in Google largely attributed to that $75 billion plus stock buyback that they announced. Hard to fight that. But you don't want to let these big names mask the bigger picture, right? So you don't want these big trees masking the picture of the forest, right? And what we see underneath the hood, once you peel back Microsoft, NVIDIA, or Google, is that the majority of stocks in technology are starting to deteriorate, are starting to break down, are starting to show serious signs of cracking. So we want to be really, really careful about drawing a conclusion from the stocks that we all know. There are only 3 stocks, right? There's tens and tens and tens of stocks within the tech sector. So we want to look at the majority of the population, and the majority of the population is beginning to struggle. And it's important because when we look at energy and materials as a sector weighting in the S&P 500 versus just 2 stocks, Apple and Microsoft, it's quite crazy when you actually think about this. Does this make sense that Apple and Microsoft, 2 companies, are 14% of the S&P 500? All of energy, all of materials, that includes gold, copper, iron ore, chemicals. On the energy side, all of your exploration and production companies, all of your refiners, your pipeline companies, all of those, we're talking close to 100 stocks, are only 6.1% versus the 2 companies, Apple, Microsoft, 14.3%. We think there's, over time, this is a reflection of an extended trade in growth in general, and that there will be some reversion to the mean in the market where energy benefits from that, and perhaps these big names such as Apple and Microsoft don't benefit as much. And so I think, again, something to pay attention to. It's something that we've taken action on in our portfolios. And when we think of global technology, the one area that we actually are investing in within tech is overseas. So when we look at Chinese tech names, right? So we look at names that could be like Tencent or Alibaba or Meituan. When we look at those types of names, these are global. These are global Chinese tech platforms. Their valuations remind us a lot of where U.S. mega cap tech was just 2 years ago. And obviously, we saw the returns in those names. So when we look at the valuations right now, the white line is a basket of mega cap Chinese tech, and the blue line is U.S. tech. And you can see these have deviated quite a bit. And right now, we're seeing a lot of good signs coming out of China in terms of the economy, in terms of the valuations. And so we would rather be sellers of U.S. tech and buyers of Chinese tech. And it's not just Chinese tech. Even Chinese banks are breaking out. Because remember, they were supposed to be going through this property spiral downward. Very interesting that you have this narrative of the Chinese economy collapsing. You have this narrative of property prices collapsing, yet Chinese banks are breaking out. Yet China tech is starting to break out. So when we look at copper, which China amounts to over 50% of copper demand across the world, they are the 800-pound gorilla in the copper market. Again, follow through highs. Market pulled back, copper broke out. Market bounce, copper keeps breaking out. So there's something happening here that is contrarian or not aligned with what we hear in the media. So in summary, let's focus on the forest, ladies and gentlemen. Solid market response to an oversold condition, but we do think more work is needed. We don't want to chase those oversold areas within the market. We want to embrace those areas that have strength. And those areas of weakness include technology. We continue to see major cracks forming across the average technology stock. Where we are seeing strength is in China and the emerging markets and energy and other value stocks within the US. So that's where our focus is. 888-543-3776. If you have any questions, please feel free to reach out to your advisor. And I hope everyone has a fantastic week. Thank you and have a great day.